You know how some companies look amazing on the outside, just crushing it? But do you ever wonder if they're secretly on the verge of a cash crisis? Well, today we're diving into a really powerful financial tool that gives you something like X-ray vision to see what's really going on.
Right? It's a classic problem. A company can be posting record profits, but if their actual cash runs dry, they are in some serious trouble. So how do you spot that invisible threat? We're about to show you the one single metric that basically acts as a financial lie detector.
Okay, so let's start with the basics. We're going to talk about a company's liquidity, which I know sounds like a fancy term, but it really boils down to a simple life or death question. Can they pay their bills? Like right now.
I want you to think of it like an iceberg. The successful, profitable company that you see, that's just the tip. What you don't see, under the surface, could be this mountain of debt and bills that are due. And look, if a company can't pay its suppliers or its employees today, it really doesn't matter how great its sales were yesterday. We need to see what's lurking below that waterline.
And this is where it gets powerful. We're going to arm you with a tool called the quick ratio. Seriously, think of it as your new financial superpower. It's the ability to see a company's true, immediate financial health all in a single number.
Let's just break that down real quick. Short-term obligations, those are basically the bills on the kitchen table, the ones due within the next year. Liquid assets, that's the cash you have in your pocket or in the bank ready to spend. So the quick ratio is just asking, does the company have enough ready cash to pay those immediate bills without having to, hold a fire sale? And here's a cool little piece of trivia. It has a nickname, the acid test ratio. Why? Well, just like old gold prospectors used to use acid to see if they'd struck real gold or just fool's gold, this ratio is a really harsh, unforgiving test to see if a company's assets are the real deal.
To put it another way, think about it like this. If you have a bill that's due tomorrow, the quick ratio is like checking your wallet and your bank account for cash. It doesn't count on you having to pawn your watch or sell your car to pay that bill. No, it's a measure of what you have on hand, right this second.
So, you ready to put a company to the acid test? Awesome. Let's get our hands dirty and look at the simple, but kind of brilliant formula behind the quick ratio.
Okay, the formula itself is pretty simple, but step 3, that's where the magic happens. We deliberately exclude inventory. So why do we do that? Well, imagine a big retail store that needs cash, and they need it fast. They'd have to slash prices, right? Maybe 50% off, just to sell everything quickly. They're not going to get the full value. So by totally ignoring inventory, the quick ratio gives us this brutally honest, almost worst-case scenario look at a company's ability to raise cash.
All right, enough theory. Let's actually put the quick ratio to work in the real world. Let's see what it tells us when we look at two competing companies.
Now, before we look at the companies, I want you to remember this number, 1.01. This is our key benchmark. A ratio of 1.0 means a company has exactly $1 of easily accessible cash for every $1 of debt that's coming due. So anything higher than 1 is generally a pretty good sign of health.
Okay, so let's meet our two companies. We'll call them ABC and XYZ. Now, at a quick glance, they look kind of similar. Both have tens of billions of dollars in liabilities. But just watch what happens when we apply the quick ratio. These numbers are about to tell a pretty dramatic story. And there it is. Wow. It's a night and day difference. Company XYZ is sitting comfortably above our 1.0 benchmark. They are financially sound, at least for the short term. But company ABC, oh boy, they are in the danger zone. With only 45 cents of ready cash for every dollar of debt, they are literally walking a financial tightrope. This is exactly the kind of giant red flag the quick ratio is designed to wave.
So, is a higher ratio always better? Is this the only number we need to look at? Well, like any tool, you really need to understand its quirks and its limitations. It's not always so simple.
The key thing to remember is that the quick ratio is a snapshot, not a crystal ball. It tells you about a company's health right now, at this exact moment in time, not what's going to happen next month. So yeah, it's a vital clue, but it isn't the whole story. And this is interesting. A really high ratio isn't necessarily a sign of a perfectly run company either. It could actually mean the company has way too much cash just sitting around, not being put to work, not being invested in new products or new markets or innovation. It's all about finding that healthy balance between being safe and being productive with your capital.
So what's the big takeaway here? How can you use the quick ratio to become a smarter investor or honestly just a more informed observer of the business world?
So if you remember anything, let it be these points. The quick ratio is your go-to for a fast, tough check on a company's short-term financial stability. It's designed to signal risk, it highlights strengths, and it gives you a much clearer picture than headlines or profit numbers alone ever could.
The bottom line is you now have this really powerful tool right at your fingertips. So the next time you read about a company, don't just look at the headlines. Dig a little deeper, find their quick ratio, and see the real story for yourself. Go on, give it a try.